Welcome to the Allan Small Financial Show. Thank you for taking some time out of your busy day to spend it with us. I think we have a great show for you today, a show that I guess we created it out of all the questions I've been receiving over the past few weeks. Questions from individual investors, questions from my clients. We have a fantastic guest to talk to us a little bit about gold, the idea of gold as an investment. How does that work? And should it be right for everybody, or is it right just for a certain type of investor? A lot of good quality topics and answering the questions that you may have today. So here are our topics. As you can see, we have gold as an investment. We're going to speak to David Garofalo, Chairman and CEO of Gold Royalty Corp. David's been in the gold industry for many years. He's worked at a number of different firms, and he brings a unique perspective on gold and why it's so important for individual investors to consider gold as an investment. We have our usual This Week segment. What should investors consider over the next 5 to 10 business days before you make your investment decisions? Why are stocks going up to start the year? It's interesting, we turned the calendar from 2022 to 23. Nothing much really changed, yet the stock market has rallied over the first 5-6 weeks of the year. Why is that happening? This time it's different. How many times have I heard that in the last, 10, 20 years? This time it's different. It's not the same as we've seen in the past, and we have to be more cautious. Well, usually this time is not different. We'll talk a bit about that. Will Meta make a comeback? For those of you that don't recognize the name Meta, that's Facebook. Parent company of Facebook is now called Meta. And what is disinflation? We all hear about this high level of inflation. We all see our grocery bills going up, gasoline prices going up. But what is disinflation, and why does the Federal Reserve keep speaking about it? And lastly, we'll take your questions. I'd like to get to at least 2 or 3 questions, if I can, at the end of every show. Try to answer what you may be thinking about, answer the questions you may be thinking about, give some insight into some things that perhaps you've been thinking over the last few weeks. So without further ado, let's get on with the show. I'd like to welcome David Garofalo, Chairman and CEO of Gold Royalty Corp. Dave was named Mining Person of the Year in 2012 by the Northern Miner. He was also Canada's CFO of the Year by Financial Executives International Canada in 2009, Top Gun CFO by Brendan Wood International 2009 and 2010, and he was recognized by IR Magazine for Best Investor Relations by a CEO in 2011. David is kind enough to join us all the way from Vancouver today, and I'd love to welcome David Garofalo to the show. Thanks for being here, David.
Hi, Allan. Delighted to be here.
Fantastic. I get a lot of questions regarding gold. Is gold a good investment idea for me? How does the price of gold move? It's so volatile. Does it make sense? So I thought we'd start off the show and talking a bit about the price of gold. What causes the price of gold to move? Does it move like other metals? Does it move based on the US dollar, supply, demand? What do you think moves the price of gold most, especially that we've seen recently, the price of gold moving up and down quite a bit? I think the other day I saw the price of gold actually down about $50 an ounce. So in your opinion, what would move the price of gold most, and what should investors be looking for?
Well, I think all the factors you mentioned earlier really do have an impact on gold, but predominantly gold is a currency. It has been a currency for 4 millennia. And currencies trade relative to each other based on relative interest rates. And gold, as a financial instrument, yields 0. However, treasuries these days, whether it's US treasuries, Euro treasuries, Canadian treasuries, are actually yielding negative on a real basis. If you look at the nominal interest rate, less where the rate of inflation is. So in other words, inflation in its insidious nature is eating away at capital. If you own a treasury, you're losing a little bit of purchasing power every day. That's certainly not the case with gold. It maintains its intrinsic value. It has physical properties. It's not the obligation of any government, as fiat currencies are, and that's why gold is dominated as a currency for as long as it has. It's appreciated, relatively speaking, of late because of the state of real interest rates, which is in the negative territory. And it's our view that it's actually quite entrenched in negative territory. I think inflation is here to stay. And even as nominal rates go up, inflation rate seems to be accelerating, driving real interest rates down deeper and deeper into negative territory.
So you would say the inflation rate itself being as high as it is, and obviously central banks are trying to fight it right now by raising interest rates. So you would say the inflation being high today is really what's taken gold back up to near its all-time highs?
It is, and I believe that we have quite a bit more traction and quite a bit more upside than what we're experiencing right now, because even though the central banks are making motions to tame inflation, in fact, that's really not what they want to do, because the level of debt globally relative to where it was in the last big inflation cycle in the 1970s is considerably higher. Debt to GDP globally today is 350%. Back in the 1970s, it was only 100%. So the central banks back then had quite a bit of more latitude to raise interest rates in order to tame inflation. In fact, that's what they did. We saw interest rates go as high as 20% plus to tame headline inflation numbers that were 14, 15%. Today, there's really no appetite for central banks to raise nominal rates beyond the 6, 7, 8% headline inflation numbers, because that would actually bankrupt governments and put the fiscal balance in North America at severe jeopardy.
Yeah, it makes sense. And we talk on the show often about real rates of return. And you make a great point that obviously with inflation here in our country in and around 6%, you're looking at bond yields right now, even though they're significantly higher than they were at the start of 2022. Still, when you subtract inflation, a lot of these investment vehicles are earning a negative rate of return. So let's move over to, I guess, investments. Why would an investor own a gold mutual fund, a gold ETF, or a gold investment in general? Are they owning it do you see them owning it more for growth? Are they owning it as a hedge? Are they owning it even from I guess, more of a defensive, for defensive nature, against what's going to happen in the future? Why would you, I guess, recommend, or why should an investor consider owning a gold investment vehicle?
No, it's an excellent question. And if you believe in gold as an asset class and its ability to protect your savings in an inflationary environment and in low interest rate environment, low negative interest rates, then really you have to ask yourself, how do you best play gold to get optimum leverage to the gold price? And there are several ways to do it. You can buy the physical commodity. You can line up at the Bank of Nova Scotia or whatever bank with your driver's license and then buy a bar, buy a coin and store it in a safety deposit box under your mattress, as it were. And then you have storage costs to incur when you do that. But at least you have the protection, the physical properties that gold brings, its indestructibility and its fungibility. You can take gold anywhere in the world. And it's recognized for the intrinsic value that it brings to the table. You can also buy an ETF that's physically backed by gold, whether it's on Toronto or New York, and that gives you that kind of physical gold holding without having to worry about where to store it. You can buy mining equities. And what mining equities is provide you leverage through their profitability. As the gold price goes up, their profitability, their margins should go up disproportionately to the gold price and outperform. Unfortunately, mining companies are not immune from cost inflation that we're experiencing in the general economy. And so that's why after 30 plus years of building and operating mining companies, I've actually switched over to a royalty vehicle where we own royalties on the mines and we get top line exposure without being exposed to the operating and capital costs of the mine. So we get a percentage of the gross revenue. That gives us leverage to the gold price upside while protecting our shareholders from inflation, but also gives us leverage to the exploration efforts of our operating partners. So when we own a royalty on the mine and the operator starts to explore around their deposits and grow it geologically, we get the benefit of that because our royalty extends to the geological growth of the deposit as well. So it's really the best of all worlds. And over time, it's vastly outperformed the commodity royalty companies have, and it's certainly vastly outperformed the mining companies that have that kind of cost inflation exposure.
And I guess it sounds like at reduced risk as compared to the other ways of owning gold.
Yeah, absolutely. And the other factor is the diversification we have in our portfolio. We have over 200 royalties in our portfolio. Even the biggest operating companies in the world, whether it's Barrick in Canada, Newmont in the US, can't hope to own more than 12 to 15 mines in their portfolio. It's impractical for them to operate more mines. So they can't nearly achieve the level of diversification that we're able to achieve within a royalty company and the scalability. I run over 200 royalties in our portfolio with 8 employees. I could run 2,000 royalties with the same 8 employees. So every incremental dollar of revenue goes right to the bottom line. And within 10 months of our IPO, we were already paying a dividend.
So that kind of takes me to another question I get asked often is, how much gold is there in the world? Obviously, we look at certain commodities, metals, let's take oil, for example. There's always talk, how much oil is out there right now. And obviously oil is something that we need, even though we're trying to get better and better and more environmentally friendly, we still are relying on oil. But when it comes to gold, how much gold is there? You mentioned all these companies mining for it. Isn't most of the gold being held by central banks in various countries around the world, like China? Every once in a while we hear about China and their gold reserves, or India and their gold reserves, increasing their gold reserves. So how much gold actually is there? And are these companies still actively pulling it out of the ground as much as they were before? And who is stockpiling all the gold that they're getting right now?
No, it's an excellent question. And there's only about 200,000 metric tons of gold that's been mined since the beginning of time. And all of it is on the Earth's surface. Much of it is in central bank vaults as part of the reserves. A lot of it is around people's fingers and wrists. So it's all there. It's all available. It's all above surface. But just to give you a sense of how much 200,000 metric tons is, it could fit into an Olympic-sized swimming pool if you took all the gold in the world and melted it. So volumetrically, it's a tiny amount. And in fact, if you look at it as a percentage of people's asset portfolios globally, it's a small fraction of 1%. So as you can imagine, a small reallocation of weighting, of portfolio weighting into gold would have an explosive impact on the gold price because there's so little of it on the Earth's surface. And to give you an example, you mentioned China. China is the biggest producer of gold in the world as a country. They mine more of it than any other country in the world, but none of it leaves their shores. And in fact, on top of that, they're the biggest importer of gold in the world. They've surpassed and eclipsed India, which used to be traditionally, for cultural reasons, one of the biggest importers of gold, still is, but China's eclipsed them. What that tells you is at the individual level and at the government level, within the central bank in China, they're diversifying into physical gold as rapidly as they can because they are concerned about the underlying fiat currencies globally and the undermining of those currencies through monetary expansion, low interest rates, both on a real and nominal basis.
It's interesting, China, they obviously buy a lot of U.S. debt, and U.S. dollars, Japan as well. So it's interesting to hear that China is taking in all this gold. Gold, as we know, a hedge against U.S. currency. And at the same time, they have a lot of money in U.S. currency. So they're kind of hedging their bets both ways. But you often hear that China is pulling back from the U.S. and U.S. dollars. You wonder if they're kind of betting more so on gold at this point than buying more dollars, whereas Japan seems to keep buying dollars and everyone around the world keeps buying U.S. dollars as the most dominant currency. So I guess China, you're right, hedging their bets a little bit by owning a lot of gold, and sounds like they continue to buy more and more on an annual basis.
It's true. And it's not a coincidence that the US dollar, as the recognized reserve currency in the world, has the biggest reserves of gold at the central bank level by far. And so there is a correlation between the two, and China recognizes that. They recognize that if they want to create an alternative reserve currency, they need to physically back that with gold. Even though the U.S. abandoned the gold standard back in the early 1970s in order to fund a war in Vietnam and print more money, it still recognizes the intrinsic value of having their currency backed by a lot of physical gold.
Yeah, it's interesting. My son did a project on currencies, and we talked about when the dollar was backed by gold back in the early 70s and how it all works. So very interesting. I guess my final question is a question that, again, sign of the times, right? Cryptocurrency. You hear a lot about how cryptocurrency now, Bitcoin in particular, I guess, is taking the place of gold. That a lot of the younger investors, the younger generation, instead of buying gold as a hedge against the US dollar, they're going into crypto. Do you think that has, I guess, dampened the price of gold at all? Do you think it's caused the price of gold to not get to as high as it is? Let's face it, we're seeing, like you said, inflation, interest rates as high as they've been in the last 40 years, yet gold seemed to top out in the $2,000 an ounce range. It didn't really go above that. You would have thought maybe you would have seen gold shoot to all-time new highs on a regular basis. Yet many believe that, individual investors, especially the younger generation, moving more money into crypto versus gold. Do you think that's having an effect on the price of gold?
I think in the short term, absolutely. And in particular, in the last couple of years, when we saw a flood of new capital go into cryptocurrencies, at one point, there were 8,000 different cryptocurrencies in the market. That's been somewhat rationalized given what's happened in that market. There's been a bit of a crash there. And I think the fundamental issue with many of those cryptocurrencies, they have no intrinsic value. They have no physical properties. They're not fungible. They're not recognizable as currency globally. You can take an ounce of gold in any country in over 240 countries in the world, and you'll get value for that gold. You can't say that with cryptocurrency. That being said, I believe Bitcoin's here to stay. I believe the blockchain is fundamentally changing the way we do business and driving transactional friction costs out of our system. And you need a digital currency in order to participate in that. But you don't need 8,000 of them. And you certainly don't need ones that have no physical properties. And the collapse of FTX demonstrated that they were creating currencies out of thin air. And, it was a kind of a perceived fiction that those currencies had value. And it was a fiction. Gold has been a currency for 4,000 years for a reason, and will continue to be the ultimate currency because it can't be printed. We're only adding about 2% to global supply per year. You asked about the state of mining earlier on. We only have 6 years of reserves in the ground as an industry. We haven't been replacing what we're depleting. They're down. Reserves are down for about 40% from their peak in 2012. So the supply is diminishing, and we don't have elasticity of supply to price. So gold could go to $3,000, $4,000 an ounce. The industry can't just turn on new supply. We're at about 97, 98% capacity utilization in the industry. Reserves are depleting. So we can't react given the lead time from discovery to first production of a new mine typically is 15 to 20 years. So there isn't that kind of reaction that you're going to see in supply in reaction to higher prices. Whereas with cryptocurrencies, if they go to the moon, somebody's just going to create another one. And that's exactly what happened. And that's why that house of cards collapsed the way it did.
Yeah, I agree. I've said the technology behind the crypto, I think, is here to stay, the blockchain technology. The question is, which of these currencies will stick around? It's kind of like, other things that have come and gone, other fads, whether it was the marijuana sector. Many of the companies disappeared, unfortunately, and the largest ones survived. And I think it's going to be the same thing with crypto. We'll have Bitcoin, perhaps, maybe one or two others. But I think at the end of the day, it's the technology behind the crypto that I think is beneficial to all these companies, and that will stay. So I agree with you 100%. David, thank you so much for being on the show today and giving us some insight into how gold works, the price of gold works. I think a lot of individual investors, they're always asking me, should I be adding some gold at this time, especially with inflation this high? You've given us some food for thought there. And, how the royalty investment works and all the different ways that you're offering investors an opportunity to invest in gold. I think that's fantastic. Again, thanks for coming in from Vancouver. I know it's a little earlier there than it is here. So thank you so much for being on the show.
Thank you, Allan.
All right, take care. This is the part of the show where I talk about what I believe individual investors should be considering as they make their investment decisions over the next few weeks. I always like to come up with 3 key points or ideas that individual investors need to consider. You can see them here. One that we always seem to talk about, Federal Reserve or central bank speak or what they're saying. These individuals tend to do a lot of interviews, and what they say in these interviews definitely moves markets. I want to talk about the current rebound and how individual investors should look at the current rebound when they make their investment decisions. And lastly, dividend paying stocks. Should individual investors just consider dividend paying stocks if we think a slowdown in the market is coming? So let's talk about what the Federal Reserve is saying. And interesting enough, we saw an interview by Jerome Powell, head of the Fed down in the US just yesterday. He spoke about a number of things and basically said that he sees inflation starting to fall, but believes that this is going to be a long battle, that the battle has just begun, and that it may take a few more rate hikes before we see inflation get down to the levels that they want to see. And interesting enough, when the interview began, the market was up. About a quarter of the way through the interview, the market fell on that idea that the Fed may raise rates still a few more times. And then by the end of the interview, the market was up again because many investors believed that if Jerome Powell wanted to be a little bit more negative or hawkish, he would have been. And he actually came off a little bit softer, talking about how we're seeing inflation pulling back versus having more of a hard hand. We also heard from other Federal Reserve governors earlier in the week as well, speaking a bit about how they think interest rates will have to be even higher, go above 5%. We see, I think we have a chart of jobs data that came out of the US recently. You'll notice that the month of January, jobs growth over 500,000. There it is there, kind of almost on par with what it was back in July and in January. So a big jump in jobs data, jobs growth. And the Fed said if we continue to see hot inflation data, hot jobs data, that they may have to raise a few more times. I think we have another quick chart here on consumer price index, where inflation is in the US. You can see it starting to come down. It's a chart we've shown before, down to about 6.5% on inflation. And also shows that if you strip out the volatile food and energy, you're looking at just under 6%. So inflation definitely starting to come down in the US, but not nearly as much as the Fed would like. Second point to consider, as I mentioned earlier, before you make your investment decisions, is the current rebound in the markets. How much the markets have rebounded in January already. And it's interesting to note, you're seeing this rebound in many different areas, but I wanted to point out a few charts, specifically the chart of Meta. If we could put up a chart of Meta that will show a significant rebound in the stock. There it is. So we came into this year, you can see it here, the chart, stock had been down significantly, and we've had a tremendous rebound. The stock has actually doubled off its 52-week low, or its low point at the end or at the fall of last year. And so a big rebound. Do you want to look at a name like Meta? Do you want to invest more dollars in Meta at this point? I think the answer is you can, if you can obviously handle the risk tolerance or handle the risk that a name like Meta brings to the table. But I think Meta will continue to grow further. I think the price of Meta will continue to move higher. Another stock I wanted to show is NVIDIA, a chip maker in the US. You can see here, when you look at a chart of NVIDIA, how much NVIDIA has gone up this year. Again, doubling off the lows. It's a semiconductor or chip makers in the US. Took it on the chin last year, as I've said in other broadcasts. And here we have NVIDIA doubling off the lows. And a name like NVIDIA, a name that maybe I wouldn't look towards adding new money to at this point. I think it could still move higher, but I would say it's more of a hold than a buy opportunity. Then moving to another few stocks, let's pull up one, Amazon. I think we have a stock, our chart of Amazon. You can see the stock has moved up, far right-hand side of the chart, but not nearly as much as a Meta or NVIDIA. I think there's a lot of room for a name like Amazon to move higher as AWS gets back on its feet, which is their cloud business, makes up a big chunk of their business. It's growing by just over 20%. Once upon a time, it was growing at 30, 40%. So I think a name like Amazon can make sense for a rebound, whereas a name like NVIDIA may have already rebounded significantly and a name you may want to move away from. And lastly, here's a chart on Alphabet. Alphabet today is actually down about 7 or 8% on the news that Microsoft is really moving forward into search using the chat GPT, the artificial intelligence to help them with their search. And everybody is starting to talk about how Alphabet or Google may be in tough with their search going forward. So names like Alphabet, names like Amazon haven't rebounded as much. Names that I think you can consider, whereas a name like NVIDIA, you may want to hold for now. Name like Meta has already rebounded, but I think there's still some room to go. So wanted to give you a glimpse at 3 different types of stocks that you can look at in different ways. The last topic that I wanted to point out for individual investors to consider when you make your investment decisions is this idea of dividend payers. And coming into this year, everybody talked about going into a mild recession. And if we are going to go into a mild recession, how can investors make money? Well, answer, through dividends. And a couple of stocks that I've been asked about recently, we'll pull one up, a chart on one of them right now, is BCE, or Bell Canada. BCE is an interesting name. It pays a 6% dividend. There it is right there. But as you can see, it's sort of range bound. It has its small dips and bounces back. But overall, in my opinion, a name like BCE paying over 6% in dividends right now, fantastic if you're looking for income, but not so great if you're looking for growth. Another name, Enbridge, which we'll also show you a chart of, also pays over a 6% dividend. But as you can see there, very consistent. The ups and downs, the peaks and valleys aren't as great. But again, for income, a great investment. For growth, not so great. So I think it's going to come down to the individual investor. What are you looking for? Are you looking for income? Are you looking for growth? Or are you looking for a bit of both, growth and income? And that's really going to dictate what you should be looking at when you're looking for some investment opportunities or investment options. A lot of these names pay great dividends, but don't have a lot of growth. A lot of names like Alphabet or Amazon have a lot of growth potential to come, but they don't really pay any dividends. So when someone asks me, Allan, what do you think about Bell, or what do you think about Enbridge? The answer always is the same. Well, what are you looking for? What do you want out of your investments? What are your investment objectives? And that will dictate whether dividend payers is right for you for this upcoming year. So why are stocks going up this year? You know, we came into January on a bit of a down note. December was a bit of a soft month. And we started to see the markets rise at the beginning of January. And that momentum is carried into February. First week and a half of February, the markets have been on a bit of a tear, and if you will. If you're looking at technology, the NASDAQ, technology has been leading the way, but we've seen a rise in bank stocks, some retail stocks. The rise has been right across the board. And in my opinion, the reason for the rise is sort of different than what we anticipated coming into this year. And I have a Starbucks chart to kind of illustrate my point. So we all thought coming into this year, we were going to see a few interest rate increases at the beginning of the year, and the markets would probably gain some traction midway through the year once the Bank of Canada and the Federal Reserve put a pause on rising interest rates. Well, in fact, what has happened is the rebound has taken shape much sooner. And I believe what has happened is individual investors sort of looked around at the beginning of the year and said, what stocks or what investments fell the most? Which ones are good quality? Which ones out of those good quality names have fallen the most? And they went into those names. They invested in those names. So we've seen a pretty big rebound in these names. But what I think is going to happen is we've seen an initial rebound. I showed you a couple of stocks earlier that we've seen some tremendous rebound in. But I think by mid-year, you're possibly going to see that rebound peter out, maybe perhaps as early as the second quarter, because to get back to all-time highs or even surpass our old all-time highs, we're going to have to see earnings growth. And right now, the earnings potential or earnings growth just doesn't seem to be there as yet. So if we pull up that chart on Starbucks as an example, Starbucks reported really good earnings. I thought really good earnings, but they said things are getting better, for example, out of China, second biggest market for Starbucks, but still not there. So Starbucks stock started to move higher based on a reopening out of China, based on strong sales out of the US. But now we're starting to see a bit of a flattening out. Starbucks hit about $110 a share, pulled back now to about 106, maybe got as low as 103, 104. And so I think you could see a name like Starbucks kind of flatline or go sideways for the next little bit, because I think the rebound in a name like Starbucks has already happened. Maybe we get another few bucks to the upside, but the majority of the rebound, I think, has happened. So I think you want to take note of why stocks are going up. You want to, the rebound that we've seen in stocks has been great. This is why stocks have gone up, because they just went down too far last year. What goes down quickly goes up quickly. And that's what we're seeing. But look for stocks to perhaps trend a little sideways as we start to focus more and more on earnings versus what was simply sold off the most. And let's get into those names. When we start looking at fundamentals again, which will probably happen in the coming quarters, look for this initial increase in the stock market to kind of trend sideways, at least for a little while, until earnings catch up once again. How many times have I heard the saying, this time it's different, Allan? I can't see the light at the end of the tunnel. I don't think we should be investing. I think we should be selling our investments. Heard that many times over my 25-year career, managing money, making recommendations to individual investors. And I can tell you that this time is never different. Perhaps the causes of concern or for the concern are different, but what happens in the markets, how the stock market behaves, is never different. In fact, it's very similar each time. We have a few charts to illustrate that point. And I bring up this point again. Coming into this year, we saw a number of stocks, a number of investments that were very cheap. And I would go to individual investors and say, perhaps if you have some money to invest, it's a good time. We had a lot of large quality companies that sold off. And I thought coming into this year, be a good opportunity, especially if you had a longer term time horizon to get into some of these names. So if you look at the S&P 500, which I think we have a chart on, the S&P 500 from, for example, 2007 to 2009, you can see it clearly here. Here's the dip, the financial crisis. And look what happens right after. We get into 2009, spring of 2009, stock market takes off and really never looks back. And in fact, some people actually doubled their returns in 2009. Take a look again. We fast forward to 2020. COVID hits in the March of 2020, as you can see here. Stock market falls. And then look what happens right after it. We see a surge in the markets, making all-time new highs. And everybody says to me, Allan, how can markets go up when we're all in lockdown, when we're not at our jobs? How can the market move higher? Simple answer is the market looks forward. The market looks ahead, 6 to 12 months. It was telling us things were going to get better. We didn't believe it at the time, but the market was telling us things would get better. And in my opinion, this current time, this environment, higher inflation, higher interest rates, brought down the market in 2022, but this time is not different. We're going to see the markets rebound, and they will rebound back to their former highs, and they'll surpass those highs once again. We just have to have patience. We have to build good quality portfolios, and we have to make sure that what we own makes sense for us. Stay diversified, stay good quality, and I think all individual investors will be fine over time. Question I get often, will Meta ever make a comeback? And again, for those of you not familiar with the name Meta, Meta is basically Facebook. Facebook changed its name to Meta. So Meta is the parent company. And underneath Meta, you have all the individual companies, Facebook, Instagram, WhatsApp, Oculus, et cetera, et cetera. So the question is, will Meta ever get back to its former highs? Well, as I showed you earlier, a chart of Meta, it's doing a pretty good job at it so far this year, doubling off the bottom. So I think, as I said earlier, you're going to have to see Meta come in with good earnings. They're moving into artificial intelligence. They're moving into the metaverse. But we heard on its recent conference call, Mr. Zuckerberg say that they're focusing on what's making for money for them today. Yes, they're still spending money on what they believe will make money for them tomorrow, although they've definitely cut costs in that regard, which is huge, and why one of the reasons driving the price of Meta to I guess, high points for this year. But still, Meta was over $300 stock. Today, it's around $185. Is it going to move higher? I believe the answer is yes. Whenever you have a business that is so powerful as Meta or Facebook, when you have 3 billion users, yes, billion with a B, on your platform every month, 2 billion users use your apps every day and are on your platform every day. That's very powerful. And if, as a business, you can figure out how to monetize that and continue to monetize that, continue to make money from that. They haven't begun to monetize, in my opinion, the power of WhatsApp. And when they can do that, and the reels and the stories, Instagram stories and reels, I think this is a company that will regain its former glory and move higher once again. So those individual investors looking at Meta today, yes, it's bounced off its low points. I believe we will not retest those lows. And I think over time, Meta will continue to move higher. What is disinflation? You know, we always hear about inflation, but what is disinflation? Well, as the name implies, disinflation would mean coming down, but really disinflation is the rate of change of inflation. And what we've seen and what the Federal Reserve, Jerome Powell, has said recently is we've seen disinflation now in the US and we're seeing it here in Canada. And it's the rate of change of inflation. So inflation is still here, as we all know, but it's not going up as rapidly as it was before. And I think our last chart that we have for today's show talks about disinflation, or shows us disinflation. We're seeing inflation in goods come down a lot quicker than inflation in services. Services inflation seems to be stubbornly high and not falling, which is what the Federal Reserve and Bank of Canada continue to focus on. If we can see inflation in the service sector follow the same path as the goods, then I think we're going to see interest rates perhaps go even lower over time. So let's keep an eye on this. Let's keep an eye on inflation, service inflation. Let's keep an eye on the disinflation. Right now, as I said, 6.5% inflation rate. We're going to get an inflation report soon out of the US, I think as early as next week, February 14th, Valentine's Day. And if the numbers perhaps we see in the high fives, low sixes, inflation will continue to fall. And I think that will be the same case here in Canada as well. So disinflation, the rate of change of inflation, it's falling. And I think we'll continue to see it fall and hopefully get into that 3-4% range by the end of this year. So I know the show is a bit longer than we normally have. I know the interview with David went a little longer, but such a great guest, so much knowledge there that I'd love to, pick his brain and find out what's happening in the world of gold. So I'm going to probably have time to take maybe one or two questions. We'll try and get through them really quickly. Here's one here. If you were to recommend one stock to buy right now, what would it be? Interesting question, difficult question to answer. Because it's, I guess, different for everybody, right? Different for your risk tolerance, investment objectives. What would be one stock I would buy? Well, let me answer it by saying this. I think I could say names in the technology space for those looking for growth, that's where I would be if you're looking for growth. If you're looking for income or growth in income, I'd look to bank stocks. I still believe some of the Canadian bank stocks make a lot of sense from an income and growth perspective. And so even some of the US bank stocks make sense as well. Again, depending on the type of risk tolerance or risk level that you're able to tolerate. One other quick question here. RSP season coming up. How do I find out how much I can put into my RSP? What should I invest in? What should I invest my money in for RSPs this year? Do you recommend certain stocks? So yes, the deadline for RSPs is coming up March 1st. The good news is whatever you put your money into, whatever type of RSP, spousal RSP, individual RSPs, you can invest that money into anything you like. And if you're owning a self-directed RSP plan, you can invest in anything, stocks, bonds, mutual funds. Let me just see here. Is there anything, it says here, what should I invest my money into inside the RSP? As I said, it's all going to come down to risk tolerance, what you're looking for. You're looking for your RSP to grow. Most people are, because RSPs tend to be longer term. So you're usually looking for growth in your RSP. It's when you retire, you convert your RSP to a RIF, that's when you may want to have more income generating investments in the RSP. So with that, I like to close the show. Great show today. Thank you all for tuning in. I look forward to seeing everybody in a couple of weeks. I believe that is February 22nd, same time, Wednesday, 12 noon. And until then, happy investing.